Let's be real. 90% of you watching this are actively lighting your money on fire. That's not a guess. It's a statistical fact. Whether it's the stock market, crypto, or that guaranteed tip from a guy on TikTok, the math says you're probably losing. But why? Why is it that in the greatest wealth-building machine in history, 9 out of 10 people end up poorer than they started? Today, we're stopping the bleeding. I'm going to show you exactly how you're being played, why your brain is wired to keep you broke, and the 3 boring yet lethal strategies that will actually put you in that top 10%. Let's get into it.
The first reason you're losing money is because you think you're the protagonist in a movie. You think you've discovered a secret that the hedge funds with billion-dollar algorithms somehow missed. Here is a reality check. You aren't Christian Bale in The Big Short. A study by Berkeley found that individual investors underperform the market by an average of 6.5% annually. Why? Because you're trading too much. You see a green candle, your heart starts racing, and you buy at the top. You see a red candle, you panic, and you sell at the bottom. You are essentially a liquidity provider for people who actually know what they're doing. You're the dumb money they talk about on Bloomberg. Most retail traders hold a stock for less than 6 months. Compare that to the wealthiest investors who hold for decades. You're playing a high-speed game of musical chairs against a supercomputer, and you're the only one who doesn't realize the music already stopped.
We need to talk about the free apps. You know the ones. They make trading look like a video game with confetti and bright colors. Newsflash, if the service is free, you are the product. These apps pioneered payment for order flow. They sell your trade data to high-frequency trading firms. Those firms then front-run your orders by fractions of a penny. It doesn't sound like much, but when you're day trading with $500, those fractions and the bid-ask spread eat your capital alive. Then there's the gambler's itch. These apps are designed by neuroscientists to keep you clicking. Every time you check your portfolio, which for 90% of you is about 50 times a day, you're tempting yourself to make a mistake. Statistics show that the more often an investor checks their account, the worse their returns are. If you looked at your portfolio once a year, you'd probably be rich. Instead, you look at it every 5 minutes and wonder why you're stressed and broke.
Let's talk about the moonshots. Everyone wants the 100x return. You see a screenshot of a guy who turned $1,000 into $1 million on some random meme coin or a zero-day option, and you think, why not me? Here's why not you. For every one person who hits that jackpot, 99,999 people lost everything. You're not investing in these assets. You're buying a lottery ticket with worse odds. The 90% lose because they prioritize speed over certainty. If I told you I could guarantee you'd be a millionaire in 25 years by investing $500 a month into an index fund, you'd tell me that's too slow. So instead, you try to do it in 6 months, lose 50% of your money, and then spend the next 3 years trying to break even. You are literally paying an impatience tax to the market.
All right, let's talk about how to actually fix this. If you want to stop being a statistic, you have to do the things that 90% of people find too boring to do. First, the 10% rule. Stop putting 100% of your investment money into speculative garbage. If you want to gamble, fine. Take 10% of your portfolio and go wild. But the other 90% needs to go into boring assets like the S&P 500 or total world funds. Since its inception, the S&P 500 has returned an average of about 10% per year. If you just did that and went for a walk for 20 years, you'd beat almost every professional money manager on the planet. Second, automated consistency. Remove your brain from the equation. Your brain is a prehistoric organ designed to keep you from being eaten by tigers. It is not designed to handle a market crash. Set up an automatic transfer. Buy the same amount every month regardless of whether the market is up, down, or sideways. This is called dollar cost averaging, and it is the closest thing to a cheat code in finance.
The biggest fix isn't your spreadsheet, it's your mindset.
You have to stop viewing the market as a casino and start viewing it as a grocery store. When the prices go down at the grocery store, you don't run out of the building screaming, "I'm losing money." You buy more milk because it's on sale. The 90% lose because they have a consumer mindset. They want the dopamine hit of the win. The 10% have an owner mindset. They want to own a piece of the world's most profitable companies and let time do the heavy lifting. Fixing your finances isn't about being the smartest person in the room. It's about being the most disciplined. It's about being okay with being boring while everyone else is chasing the hype.
So, here's the choice. You can keep chasing the 100x gains, checking your app 40 times a day and staying in that 90% bracket of losers, or you can accept the boring truth, automate your life, and let the math work for you. The market is a device for transferring money from the impatient to the patient. Which one are you? Decide today, because the clock is ticking on your compounding interest. Stop gambling, start owning. I'll see you in the top 10%.